Go. All right, everybody, welcome to the 3 best strategies for small account traders. We just spent some time without recording going over some option basics. And if you are interested in reading those, you can go over to Doc's live updates in our Discord room for the Dr. Stocks Trading Live room. And if you click on that, you'll be able to see the list of 12 rules or ways that options work. If you're new to options, that would be the best place to start. I didn't record that because most people in the room are familiar with options already. So let's go ahead and talk about 3 strategies that you can use if you are trading a smaller account. And if you're trading a larger account, you can use these too. You would just have to leverage them or apply these perhaps to larger, not larger, but more expensive stocks. Okay, so first strategy, number 1, we're going to call this the Lotto Strategy. There are 7 components to this strategy, but it is fairly simple. For this strategy, you are going to be buying either a call or a put out of the money with a fairly near-term expiration. And you're going to be doing that on stocks that are fast-moving, that are fairly low in price. And we're doing that so that you don't have to tie up too much money in margin. You know, you can do this strategy on, let's say, Netflix. Where is Netflix today? It closed at $500. You can do the strategy on Netflix, no problem at all, but you'll be paying out much more money because those calls or puts are a lot more expensive because Netflix is a stock that moves in tens of dollars and not in tens of cents. So we want to do this on smaller price stocks, and so that you don't have to pay out so much, so that you can do this in a small account. They have to have weekly options. Now, there are quite a few stocks that are lower in price and have weekly options, and the best way to get a list of those is by Googling stocks with weekly options. You'll come up with, I don't know, 20 or 30 sites that will list for you the stocks by name, by ticker symbol, and by price. And in some of those, you can sort by price. And I would keep a running list of stocks, every stock that is under, let's say, $80 a share. That's probably a fair place to cap it. And those are stocks that you'll want to be very familiar with because those are stocks that have the best, they are the best candidates for this strategy, liquid weekly options. Now, the second thing about the stock that is appropriate to the strategy is that you need to be expecting a big move overnight. By and large, that means the stock is about to announce its earnings. Okay? Most stocks on the day of earnings, we've all seen this in the room, most stocks on the day of earnings will jump up real big or jump down real big, or sometimes they don't jump up real big, but over the next 2 or 3 days, they move real big in response to the earnings. That's what we're looking for. We're looking for a big, quick move in a lower price stock that has weekly options. Now, you can do this on stocks that don't have weekly options. You can do it on stocks that have monthly options, but you wouldn't do it. You know, monthly options, they always expire on the 3rd Friday of every month. You would not do this strategy on the 4th Friday or the 4th week of the month, because then you're going to have to pay a lot more time value for those options. You can, I'm not saying you can't, but I'm just saying if you really want to keep your overhead costs for this strategy low and you want to do this on a monthly option only stock, you're best off doing this in week 2, even week 1, I suppose, later on in the week, maybe Thursday or Friday. It gives you a little bit of time for this strategy to work out, but you don't want too much time because you don't want to have to pay for all that time value. That will be wasted value. You don't want that. Okay, and in general, here's a general rule. Going into the strategy, it is best if you have a pretty good idea of how that stock is going to perform on earnings. The best way to learn that is by looking at what has it done over the past 3 or 4 quarters. When it announces earnings, does it tend to go up? Does it tend to go down? And by that I mean gapping up or down. Over the last 3 or 4 earnings, does it tend to trade higher immediately after earnings, or does it stay flat? Does it tend to go down after earnings? If it moves a lot, either on the day of or 2 to 3 days after earnings, then that is a good candidate. Make note of whether it tends to go up or down. By and large, here's a very, very general rule. Stocks tend to rally on earnings after they have already been beaten down over several weeks. That beaten down look to the chart is typical of stocks that have already priced in bad earnings. Earnings come out, maybe they were bad, but maybe they weren't quite as bad as expected, or maybe they were as bad as expected. It's already been priced in. The stock rallies on the news. We see this all the time. The opposite is also true. Stocks that have rallied sharply into earnings, all that expectation, earnings is going to be great, it's going to be the best quarter ever, historic sales growth, etc. And then earnings come out and by golly, they were good. They were very good. They were even historic. And the stock trades down. Why? Because all that news was already priced in. Okay, so pay attention to those two things. Does the stock tend to move up or down on earnings and shortly thereafter? By shortly, I mean like 2 to 3 days. And how has it been trading into this earnings report? Has it been going up? Has it been going down? Okay, if you can get a stock that tends to go up on earnings and it has been trading down into this report, boom, you've got your call candidate. If you find a stock that tends to drop on earnings and this one has been rallying, boom, you've got your put candidate. Okay, does that make sense? All right, so which call or put option are you going to buy? Generally speaking, you can buy them at the money. Now, remember, there's really no such thing as an at the money, so as close to at the money as possible, or a near out of the money with at least 5 days to expiration. At least 5 days. So if you're doing a weekly option, you could do this on a Monday, but I wouldn't do it on a Tuesday. If you find a stock that's ready to go on Tuesday, then go not with this coming Friday, but with the next Friday. Okay? So at least 5 days to expiration. It's really the last 2 days into expiration that you lose. All that time value just comes out flying like crazy. So if you've got 5 days to expiration, you've got really like 2.5 days for this stock to move. And that's enough. If it doesn't move in 2.5 days, then it turned out that this is a dud. Okay, now if you're wrong, and here's the thing, you're going to be wrong on most of your picks. This is a lotto strategy. This is a low win rate strategy with a high payout when you're right. You're most likely to lose most of that premium. Now, in probably 90% of the cases, you'll be able to sell the call or put back to the market if it doesn't work out in about 3 days, and you'll know. If it doesn't move in 3 days or if it moves in the opposite direction over 3 days, you'll know. You'll know that you're on the wrong track with this one. Sell it back to the market, get what you can for it, move on to the next trade. That's going to happen probably 80% of the time. Okay? In some of those cases, you might break even. Some of those cases, you might lose 10, 20, 30%. One or two of those cases, you might lose 70, 80%. Really just depends on how far against you it has moved. Move on to the next trade, because when this strategy wins, you can really make all that back and then some. So you can buy a call option with 5-6 days of expiration time for 30 cents. And you wake up the next morning and the stock has gapped up $2 and that 30-cent call option is now worth 90 cents. You have tripled your money. Okay? So you don't need too many triples or quads or quintuples to make up for all those little losses and the larger losses that you will get with this system. Okay, so that's why it's called a lotto system. You want to make sure that you're not paying a whole lot for your cost basis for these options. And when that happens, if you get your selection right, then two or three times out of 10, you're going to be sitting pretty with those profits. All right. So where do you find about let me get a copy of it here. Where do you find out about stocks about to announce earnings? Well, that's easy. Click on that thing I just posted there. Go to finviz.com. That's finvizcom.com. And if you're not familiar with Finviz, you should be, because it is a one-stop shop for market news, moving stocks, gapping stocks, upgrades, downgrades, option information. It's got a very good screening tool. It's all free. It is 100% free. You can keep portfolios there. You can do fundamental analysis, technical analysis. They have charts with pattern recognition software. It's all really good stuff. So if you're not familiar with finviz.com, finviz.com, please take a look at it. And every day they give a list of stocks that are about to announce earnings. This is the list for, the last couple of days going into next week. And I did pull one out. As I was putting this material together yesterday, I pulled one out that looked pretty good. And that stock is Dropbox. Let me give you a chart of it here. Dropbox isn't on the list I just showed. Oops, that's not it. Let me get a chart here of Dropbox. There you go. This is a Finviz chart, so you can see that it has drawn in for you some trend lines and some moving averages and so on, volume. All right, so Dropbox is a stock that has had a tendency to rally on and shortly after earnings. Doesn't always, but you can see back in December, a big gap there. That's an earnings gap, and then it carried on higher after that. There was one in, December, January, February, March. No, March is too soon. In any case, there were a couple of earnings. I think it was actually back in late November. There was an earnings gap, or was it early November? Anyway, so tends to rally on earnings, and look at this. It has pulled all the way back into a supporting trend line. Those are the two things you want to see. It rallies on earnings, and it has pulled back. The converse is also true. It tends to fall on earnings, and it's been rallying into earnings. Those are the two things. The first one for calls, the second one for puts. Now, it does help if you know the company, if you can do some fundamental analysis, okay? Technical analysis doesn't really have a whole lot to do with response to earnings, but fundamental analysis certainly does. See if there have been some company raising of earnings estimates recently, sales estimates. Has there been an upgrade in the last month or so? Have there been some insider buying, right? By the way, all of that you can get on finviz.com. Okay, so that is, let me show you the option tree for Dropbox. Okay, so if you, I don't know what your broker would look like if you call out the option. This is called an option tree or an option ladder. It gives you all the various strike prices and the premium, both at the bid and the ask. You'll also see delta. So if you see the column there for Delta, and at the time that Dropbox was trading, that I posted that chart on, this was yesterday. I don't know what it did today. The let's see, where was the? Hold on one sec. Let me get a second chart up here so I can keep track with y'all. Okay, so Dropbox had, like the rest of the market, had a pretty decent day today, although it closed well off the highs. But yesterday was under 25. So you could have bought, yesterday at least, the 25 calls. Those are pretty close to the money, right? We want to go a little bit out of the money. We don't want to go in the money because we want our cost basis to be low. But we want to be close enough so that we have at least a pretty good chance of getting the stock, the underlying stock, above the strike on earnings and then or shortly thereafter. Okay, so look, you'd be paying about, these are nice and liquid, by the way, and you can see that they have weekly options. There were options expiring today. If you go up to the top of the tree there, May 7th. There are options that expire next week, May 14th, and then there's the regular options that expire May 21st. This is a weekly option. They're very liquid, all good stuff. So you could have bought some call options. Maybe you buy two of them. Let's just play it safe. Two of them at about, you put your bid between the bid and the ask. Let's say 92. You get filled at 92, so you're out about $190, including commissions, right? For two options. Now, the stock today closed at where's the closing price? 24.70, and it was up 17 cents. So those options, they're probably already worth a little bit more than you paid for them. But what we're really waiting for is earnings. We want earnings to come out. Now, if earnings comes out, they're really good. The market likes it, and they start bidding the stock up pre-market. Let's say it goes up to 27. Okay, I am going to be selling at least one of those calls at the open to bank those profits. Those 25 calls, when they're trading at 27, intrinsic value says that they're worth now at least $2. Plus time value, which goes out to May 14th. That's a week away. It was 8 days away yesterday. So $2 plus maybe 80 cents in time value, $2.80. So I've got two of those guys, right? So that's $560. I paid $190 for them. That's a nice little profit overnight. I'm going to at least sell one at the open. And what often happens with earnings is that you get a nice little follow through for 2 or 3 days after the market has already pulled back, because it clearly shows that the market overshot the valuation and now it needs to catch up. And so you might get Dropbox opening up at 27, closing 3 days later at 29. At 29, those options are now worth $400 of intrinsic value, and your time value is going to be decaying. So maybe it's only $40. So $440 each. That's $880, and you only paid $190 for them. Okay, so that's where you make your money with this strategy. But keep in mind, this is a low win rate strategy. You're going to have to sit through a bunch of ugly ducklings before you get to the beautiful swan. And by the way, Dropbox did report earnings. It reported earnings this morning, and it was actually very good. Yeah, up 106%, surprising the market by 12.9%. And so it did rally up a little bit off the open. I don't know where it opened today. Where did Dropbox open? I've got the wrong chart up here. Let's see. DBX. Yeah, see, it opened at 25.09. Okay, so, you might have sold one off and you made $30 on it. You're going to hold that second option in the hopes of a 2 to 3 day rally. starting next week. So Monday, Tuesday, I wouldn't hold it past Tuesday because you'll start to lose time value too much. But maybe we can squeak out another buck by Tuesday's close, and we can get another $100 out of that option. Okay, so that's how that strategy works. Look for lower priced stocks that are about to report earnings, and it doesn't just have to be earnings. You can also have a stock that's going to have an investor day, right, where they come out and they present their new lines or their new products and so on. That can be a rally time. You know, think of Tesla on investor day, Apple on investor day. They always, if it's good, it will rally. If it's not so good, or if Elon Musk throws a rock through the windshield of his supposedly bulletproof car, the stock will fall off the next day. But there are other events that take place that can cause overnight sensations in the stock, and it doesn't have to just be earnings. Okay, let's look at strategy number 2. And this is the same strategy, the very same strategy that we used for now. Click on that, you'll get a bigger picture of it. Credit put spreads. We did a credit spread using puts on now. We sold short the 472.5 puts for today. They expired today. We did this yesterday, right? So this is only one day of exposure to the market. We bought back the 460 puts that expired today. We expected those to expire worthless, and of course they did. But those were our protections. So in case now plummeted on some unforeseen news, we would at least have the downside capped. We won't lose any more money than the difference between those two strikes. Now, this is a $400 stock, so you got to keep in mind that you're taking on a lot more risk when you're trading these big guys. But we made $110. No, $150. I think it was. Anyway, it was something like that for every credit spread that we put on. You can do something very similar. Now, you're not going to make $150, but you can do something very similar with put options on lower price stocks. This has a very high win rate. If you're doing this right, you should be winning at least 90% of your trades. The other 10% doesn't mean maximum loss. It can mean a small loss because the stock closes down just a little bit below your short put, and you're forced to cover into the close so you don't get put the shares. Okay, so you want to use this. I'm looking at A now. You want to use this on high beta liquid stocks with weekly options. All right, well, how do you know what stocks are high beta? Go to Finviz, use the screening tool there, set a cap of maybe $50 a share. Put the average daily volume at something like 500,000, maybe more, maybe 1 million shares a day. And then set your beta, the beta filter, which measures volatility relative to the S&P 500. Put it at something like 1.5, 1.8, even 2.0. The lower price the stock, the generally more volatile it tend to be. And a beta over 2.0 means that stock moves twice as far as the S&P 500. The S&P 500 goes up 1%, your stock tends to go up 2%, and vice versa. So high beta liquid stocks with weekly options. Again, Google what stocks have weekly options. You'll come up with a long list. Sort them by price. Keep a note of those. This strategy works best after a big sell-off, particularly after a sell-off down to an area of price support. Now, if you don't know what that means, I'm not going to help you in this webinar, but you'll need to know what that means. And I'll show you an example of what I mean by that in just a little bit. Here's the strategy. You're going to sell an out-of-the-money put, and then you're going to buy back. You're going to buy a further out-of-the-money put with at least 1 week of time value in both of those. So both of those puts are going to be at the same expiration date, just like we did with now, right? They both expired today. Same expiration date, but you need at least a week. So this is a strategy you would be doing Friday, You can do it Thursday, you can do it Wednesday, but you wouldn't be doing it for today, you would be doing it for next Friday. Okay, the longer time you're willing to sit in that position, the more money you can put into the bank. Now, you're going to hold until expiration unless, this is the asterisk again, unless the stock is below the strike price on the last day, the day of expiration. Then you need to close the whole position before the close of trading that day. Otherwise, you will end up with 100 shares for every spread that you have on the very next day, unless it closes below your protection put, in which case you won't have any shares because you'll be put the shares and then you'll be called back again with the same strategy. But that gives you your maximum amount of loss. Yet that will rarely happen. 90% of the time you should get 100% of the premium if you're doing this right. 5% of the time you'll be taking small losses. 3% of the time you'll be taking medium to larger losses. 2% of the time, because of some horrific news that comes out of nowhere, you will take the maximum loss. And if you total all that up, you've got a nice, steady, income producing strategy over time. Okay? Now, here's the nice thing about this. Because the reason this has a high win rate is because the stock can go up. It can go up a lot, it can go up a little, it can go sideways, or it can go down a little, and you'll still make money. There are 5 directions the stock can move in. You're going to win on 4 of them. And if you do it right, you'll have a much better percentage win rate than 80%. Okay? You just do it the next week, and the week after that, and the week after that, week in, week out, week in, week out. You're going to make your $40, your $50, your $60 per spread, per spread. And once you start making more money and you want to take on a little bit more risk, you can start doubling those, right? Instead of doing 1 spread per week, you do 2 spreads, then 3 spreads, then 4 spreads. It's best to do these on different stocks, but once you have enough stocks that you can manage properly, you can start doubling up on them. You do you sell short 2 spreads on 1 stock instead of just 1. All right, let's look at some examples of this strategy in action. Here is a good-looking candidate for this strategy. This is our old friend Fubo. Now, I would not do it on Fubo for this next week. This is not a vital candidate for this week because of earnings. You can see earnings is going to be announced. That's a little E down there. It's going to be announced sometime this next week. You definitely don't want to hold these over earnings, okay? So that would be the news out of left field that you weren't expecting that could throw you into 100% loss. Don't want to do that. But just look at the chart, okay? We are in a downtrend. That's helpful because that tends to increase the volatility in the stock, and that increases the premium that we get to take home. And as of yesterday, this was yesterday's chart, we are trading at or near prior support. You can see it got down to the same level a few weeks ago, and it rallied weekly, but it did rally up into the 20-period moving average, the top of the Bollinger Bands, and then it sold off back down again. Okay, that's what we're looking for. We're looking for just a little bit of a rally. Or it can go sideways, or it can even go down a little bit. We'll still make money. Okay, so Fubo was trading on that day. Oh boy, the price is so small I can hardly see it. Let me get a bigger chart of it here. Hold on, just give me a moment. Okay, Fubo closed yesterday at $17.07. It rallied today a little bit, about 1%, 17 cents. So if you had done the strategy yesterday, you'd already be making some money. Let me show you what the tree looks like for Fubo. Keep that chart in mind. That's the kind of chart you want to find for this strategy. Lower price stock. By lower price, I'm meaning, like under $80 a share, under 50, under 40, and high beta, right? Stock that tends to move a lot. Okay, we're focusing over here on the right side of the tree, the put side of the tree. And because the stock closed at 17, it was actually 17.19 when I was putting this together. And I have several options that I could do. I could do the next lower strike, which is 16.5. And the nice thing about Fubo is these options are very liquid. It has weekly options. They are very liquid, tend to have very tight bid and ask spreads. So I'm going to short the 16.5, and I will be getting about $1, let's say $1.20, probably $1.19 for those, somewhere between the bid and the ask. That's $119 that goes right into my account right away. I'm going to turn around, I'm going to buy back an out of the money put. I'm going to go all the way down to 12. These are only going to cost me about 9 cents, right? The spread is 0.7 to 0.10. Yeah, maybe I can get them for 8, but 8 or 9 cents, that's $8 or $9. Now I banked 119. If it cost me $9 to put on that protection to cap my downside, I'm very happy to pay that. That's my insurance cost. So I now have $1.10 or $110 per spread for in my account, simply to hold this put spread until Friday expiration next week, and all Fubo has to do is stay above 16.5 for me to make 100% of that income. Now, it can go down to 16.5. I still make 100%. It can go down to 16. It can close or get close to closing on Friday of next week at 16. I still make money because I've got $110 in my account, and now that put option is worth 50 cents of intrinsic value. I'm going to have to buy that back because I don't want to hold it over expiration. I don't want to be put the shares. I'm going to buy it back. It's going to cost me 50 cents to do that. That's the intrinsic value. There might be a couple of cents of time value on a Friday afternoon, right, close to the close, but probably not a whole lot there. So I get to keep $60 even though the stock went against me. Heck, it can go down to 15.5 and I will still make a little bit of money. I'm going to make $9, right? 119 is what was put into my account. It's going to cost me $100 to, what did I say? 15.5. It can go down to 15.5, which would be $100 below the strike price, but I made 110. So I still get to keep $10 minus commissions. So it probably would be a break even. All right, you can see how profitable these things can be, right? As long as Fubo stays above 15.5 for a week, that's all it has to be, 1 week, I get to at least take home a little bit of money. And in the best case scenario, I take home $110. Okay? You want to make sure that you're doing this at some price support. So the stock is likely to hold that area for a few days, maybe rally, and it can be a very weak rally. We don't care. And if it does go down a little bit, there's probably going to be some dip buyers that come in and knock it back up again so it doesn't go down too far. Okay, you understand that? I hope you get this idea. So we're doing put spreads. These are lower risk. Now look at my maximum risk right here is $450. That's the 16.5 strike minus the 12 strike that I had to buy, right? But I bought those so cheap, right? $9. Subtract those two, you get 4.5 times 100, that's $450. So that is my maximum outlay. And the only way I get to that maximum is if Fubo crashes in a week all the way down below 12. Okay, now a stock like Fubo could potentially crash below 12. Let's be honest here, okay? It could come out with horrible news or whatever. The likelihood of that happening, I don't know what the odds are. Maybe 1 in 1,000, maybe 1 in 10,000, something like that. Okay, so your maximum loss on these kinds of positions, if you do them right, You get them at the right price at the right strike. It just almost never happens. And yes, you will take losses on some because it only has to go below 15.5 and I'm starting to lose money. So if it goes down to 15, I'm out $50. If it goes out to 14, I'm out $150. Okay? There are ways you lose money on these positions, but consider that at every 10 that you trade, you're going to be making maximum gains on probably 5 of them. You're going to be making partial gains on 3 of them, and you'll take a small loss or medium-sized loss even on 1 or 2 of them. Okay? Put those together, and you get a nice, steady income week in, week out, week in, week out. Okay. Now, you can do this on the flip side. You can do this with calls. If you find a stock that's just going up, it's rallying into resistance and it's getting stalled there, it looks like it's going to roll over. Sure, you can do this on calls. Same principles apply. But because of generally speaking, we're in a bull market because the markets do tend to go up more than they go down. There tend to be more green days than red days, historically speaking. You're better off trading this with puts and having a bullish bias on the stock itself. Okay, let me show you one more. Yeah, let me show you one more. Everybody still with me? I know some of you will be watching this on the recorded version, but here's another one that came up on my little scan for this strategy. Here is Plug. Okay, Plug, as of yesterday, was a little bit below the support, but not too far below. Now this is another one you would not be doing because look, earnings are next week, right? See that circle E? You're not going to be doing this one on Monday morning. Okay, please do not. But where did Plug close today? PLUG. We've sometimes traded Plug in the room, but it hasn't been performing very well. Yeah, it's up. Wow, it's up 2%, 2.2% today. So if you had, let's look at the option tree for this one. And you'll see something quite similar to Fubo. They both have a similar beta profile in terms of how volatile they are. Plug is a little bit higher price. So it was closing yesterday at $22.50. You want to go out of the money, but not too far, right? The further out of the money you go, the less money you'll make, but the less risk you take on, and the higher your win rate will be. By win rate, I mean how many out of a 10, how many out of 100 trades, how many are you taking maximum profits on, how many of you are taking partial profits on. So if we went down to 22, which is the next lower strike for the puts, expiring May 14th, that's 8 days away as of yesterday, 7 now, then I would be selling those short, somewhere between the bid and the ask, about 128. It's $128 goes straight into my account. And on a $22 stock, I guess I'm comfortable taking on $500 in risk. So I'm going to buy back the 18s. That's going to cost me, let's just say 25 bucks. So I got 128, cost me 120, it cost me 25, so I won $103 goes straight into my my account. Now, here's an interesting note. We looked at Fubo, and we had a potential profit of 109 on a maximum risk of 450. Here is Plug. Potential maximum profit of 103 or 104 on a maximum risk of 500. So what you can do, if you have several of these candidates and you're trying to decide which ones, take the maximum profit divided by the maximum risk, and that will give you a percentage, and go with the best percentage, right? Gives you the most amount of profit for the least amount of risk. So in this case, Fubo trumps Plug for next week's expiration, but actually neither one is good because of earnings. Well, let me show you, oh no, I guess we looked at Plug chart already. Okay, and again, notice that Plug has very liquid options, easy to get in, easy to get out. Always use a limit order between the bid and the ask. You'll save yourself a few bucks that way. You'll pay for commissions that way, and you'll have a nice steady income. Okay? All right, so that's strategy number 2. Let's look at the most exciting strategy, the one that really got me all charged up, so charged up that I actually did one of these today. Okay, and this is the most conservative strategy, and I wouldn't call it necessarily the one with the greatest amount of profit potential, because that certainly goes to the Lotto strategy. That's the one where, you know, if you get a really big 10 bagger, which is certainly possible if you're trading a $30 call option and the stock rallies huge on earnings, those little lotto calls will pay off much better than these. But this has a high win rate, and your payouts are much better than the put spreads that I just talked about. The put spreads are going to give you the highest win rate, but these covered calls are a conservative strategy. In fact, you can do this without even a margin account. You can do this in a cash account. So keep that in mind. If you're in a cash account, you don't have margin, this is the one strategy you can do. And good news, it's not going to tie up a whole lot of money if you do it right. Now, to do this properly, we need a tool. There's a tool that I use. It's a subscription service, so I'm not going to introduce that to you because I don't want to add any more to your overhead costs. It's a service that I've used on and off over the years, and it will show me the most profitable covered calls, naked puts, put spreads, calendar spreads, straddles, strangles, on and on and on. And it's a little bit problematic, so I'm not going to recommend it necessarily. But this is a free site, this barchart.com, a free site that does everything we need it to do for covered calls. Oh my gosh, I can't. I'm so excited about this. You guys are going to love this. Okay, so before we look at the stocks that are appropriate to this strategy, in fact, we won't know what stocks are appropriate to the strategy until we get to the site. I'm going to show you this barchart.com. So when you get to barchart.com, look at number 3B here. You're going to click on the options tab, 3C, then you're going to click on covered calls, and I'll show you this in a sec. And then D, you're going to sort the list of stocks that come up by price from low to high. You're going to look at the top of that list because those are your low price stocks, and you're going to look for the best plays. I'll show you how to do that in just a minute. Then you're going to go to the charts. This is 3D2. You're going to check the charts for bullish setups. Now, I'm not going to explain how to read charts. If you want to do that, I've got 2 whole webinars that you can buy from our site, drstocks.com. The Chart Reading 101, Chart Reading 201, or you can just, if you want to save some money, buy my book, and that will help you. You need to look for bullish setups, like pullbacks or breakouts or double bottoms or inverted head and shoulder bottoms or falling wedge breakouts, things like that, okay? Make sure that the length of time that you plan to be in the position does not stretch out over earnings. You do not want to hold this strategy over earnings announcements, okay? So the best time to do this is right after earnings, but you can do it with at least a month out. But you'll see anyway, you'll see in just a minute. This will all become clear. Don't hold this strategy over earnings. And we will be using monthly options most of the time because that will give us the greatest amount of possible stocks to choose from. So the holding periods for this strategy tend to be a little bit longer. With the Lotto strategy, you're holding maybe 2 or 3 days, maybe 4 days at the most. With the put spreads, you're going to be holding in a week. With this covered call strategy, it could be a month, could be longer, could be 6 weeks or longer, could be 2 months. I don't think it'll be ever longer than 2 months, but if it is 2 months, you want to make sure there aren't any earnings by the time you get out to expiration. Okay, let's look at the site and what it looks like once you click on all those things. You're going to come to a list oh wait, here, let me do this first. This is what you will see when you get to the bar chart site. You want to click on options, and when you do that, it will drop down a menu. From the menu, you click covered calls. Okay? When you do that, this is what you'll see. Okay, you're going to have a list of stocks with the current price of the stock. Then you're going to be offered a strike price, and I'm reading these columns left to right, okay? There is the strike price of the option that the list is offering to you as a possibility, okay? Moneyness, don't worry about that. That's the difference between the strike price and the current price of the stock. Just ignore that. But then you're going to have the expiration date of that option that is being offered to you as an ideal call to sell short. I guess I'd never explained what a covered call is. I'm sorry. To put on a covered call, you first need to buy 100 shares of the stock, whatever the stock is. And we're looking at low price stocks here. So maybe like on this Atos, right? That's the one we got in today because I really like the chart. At the time, it was 243. We bought it at 248. It closed, where did it close? It closed at 264. Ooh, nice. Very nice. Okay. So Atos, we want to buy 100 shares of Atos. That is only going to cost you $243. 100 shares, $243. That's it. This is like a penny stock, right? Then you're going to sell one call option at the $3 strike at the May 21st expiration. Okay, May 21st expiration. Now, you can see that there are two options here for Atos. There's one at the May 21st, there's one at the June 18th. Atos does not have weekly options, it has monthly. So those are your two choices. If you go with the June 18th, you're going to have to hold the position longer, but you will make more money. If you go with the 521, which would be my preference, you will not hold the position nearly as long, but you will still make more money if you can do that same kind of trade again and again and again. You're making less money, but you're doing it in a lot shorter time, which means better turnover, which means more ultimate income on a yearly basis. Oh, guys, this strategy is just so good, all right? I think we might be doing a few of these in the room. Okay, so you're going to short the 521s. You're going to get $45 for those. That's money that goes into your account. Now get this, you spent $243 for 100 shares of the stock and you got back $45 from the market by selling the calls at the $3 strike for the 521 expiration. Your cost basis, look at the net debit there, your cost basis for your position is $1.98. You are already 45 cents up on a $2 stock without doing anything. Hello? Profits, cha-ching, cha-ching, okay? So don't worry about the BE, that's a break-even thing. Don't worry about that. The volume is something to note. The more volume, the better, because volume means liquidity. Liquidity means good spread, tight spreads between the bid and the ask. 4,000 is a lot. That is a lot. That also tells me that this call option, the $3 strike for May 21st, is very popular. 4,000 contracts traded today alone. The open interest, you don't really need to know that, but 20,000, I think it's 20. I can't read it. It's pretty small. 25,000 maybe. That's also big. It tells me Atos is on a lot of people's radar, and a lot of people are thinking that this is going up above 3 in 2 weeks, right? It's only 2 weeks between now and the 21st. 2 weeks from today. That's a big move. That's a 22% move in 2 weeks. Okay, so here's the kicker. Go over to percentage return. That's the fourth column from the right. Percentage return for this particular position is 51.5% in 2 weeks, guys. 51.5%. Now that is maximum gain. What do you have to do to get maximum gain, the stock has to go above 3 on the day of expiration. The stock has to be trading above 3 on the day of expiration. That is your maximum gain. If it goes to 4, 5, 6, 7, you will not make any more money than 51%. That's the only problem with covered calls. If you latch on to a real runner, you're not going to maximize your gains. You're going to be limiting your gains. But here's the thing, the stock can go nowhere. It can go sideways for 2 weeks, and I'm making 22%. Those calls will expire worthless. I still have my 100 shares. I can turn around and sell the June calls, right? $3, the $3 strike, and make some more money off those shares. Oh my gosh, this strategy is amazing. I don't know why I never thought of doing cover calls on tiny penny stocks. I never thought of it, but man, the returns are phenomenal. Now look at this. Percentage return, 51.5% for 2 weeks. If you annualize that, 1,343. Now you're not going to find that kind of return very often. If you look down the rest of the list, you're going to see some nice returns. But if you look at the annualized figure, they're down in the 200s, 300s. You don't see any 4 digits. But think about it, 200%, 300%. I see an 800% in there. Those are excellent, excellent annualized returns. If we can do this week in, week out, week in, week out, and you're only you're only tying up $243, the cost basis of those shares. That's it. So even if you have a $2,000 account and it's a cash account, you can do this strategy on a stock like Atos. Now let me show you the chart of Atos. Hold on a sec. Okay, so Atos, it has an earnings E right there, but the fact is that that's a mistake. It did report earnings about a month ago, late March. So we've got April, May, June. It's not going to report again until sometime in late June, so we've got plenty of time. And the stock broke out of a downtrend and has printed a bullish flag pattern, which is why we bought it today in the room as a little swing trade, a little Lotto swing trade. But man, you can put your little swing trade on steroids by shorting the 521 $3 strike calls. Now you are capped, you're capping your profits at that $3 strike. So if it goes up to 4, 5, 6, you're not going to make any more money. But look how much you've lowered your risk. The stock can go all the way down to $2. Right, which is, for a $250 stock, that's a 25% drop. It can drop 25% in 2 weeks, and you're still either going to make a little bit of money or you're going to break even. And if it drops below that, let's say it drops down to 180, okay? You still own 100 shares. Those shares aren't going to go anywhere. You get to keep the $45 in premium. Where are they now? They're actually at 60. So if you shorted this today at the close, you would be making $60, not 45. You can short them Monday morning, and maybe they're at 60, maybe they're not, but you can still short them Monday morning. And let's say 2 weeks later, the stock goes down to 180. Okay, you're out some money. Even though you do get to bank $60, you're out some money on the shares. But then you turn around and you sell the June, which are now, almost a month out. You short the June, maybe not the $3, maybe there's a $250 strike at that point, and you short those for maybe another $50. So that puts your cost basis from 198 down to 148. You're already back in the money again. So you can see how even on a losing position with this strategy, you don't have to worry about being called away. You don't have to worry about being put the shares. You will be called away if it closes at $3 or above, but that's what you want. You want that to happen. You get called away, your shares are gone the next day. Whoever bought that $3 strike now owns the shares that you used to own. You turn around and you do another one, right? So on 521, you either short the June calls for Atos, or you go back to the bar chart list and you find another candidate, or you stick with Atos and you keep shorting the calls 1 month out. Wow, that is That's an amazing strategy. Let me show you one more that showed up on that list, and it's one that we've been trading in the room, and I know a number of you are very interested in. It's been in this major pullback for several days now. Microvision. It's been hovering around support, so this is actually a pretty good place to put on this strategy. It is below a support level, which will act as resistance once it gets up there. You can see it got up there a few times over the last week and got rejected each time. So this is likely going to trade in a fairly tight range. And according to, let's go back to the list, right? You go back to the list and you look down at the bottom of the list, you'll see 3 options for Microvision. The 15 strike, which is just a little bit out of the money, the 16 strike, and the 17 strike. Now, Mavis is a big mover. It could move, I don't know, 10 bucks in a week. It probably won't, but it could. So maybe going with like the 17 strike will give you a little more upside cushion, which means you're going to make more money on your shares, but you will take home less money from the calls that you sold short. But look, these are going on to June, right? So there aren't any, well, there probably are May, but for whatever reason, the software decided that they weren't worthy of putting into this list. So we've got 3 June options, 15, 16, and 17 strike, and you can take home either 270, 240, or 210. I would go with the 17s at 210 because that gives you $200. Oh, wait, where did the stock close today? Okay, the stock closed today at 1410. So that gives you, excuse me, almost $300 of upside on the shares alone, plus the $210 you're going to get from selling those calls short. That's 500 and, what did I say? My brain is shut off. 290 plus 210 is $500. $500 for holding a stock that's going to tie up $1,400 only of your cash. So if you're in a $2,000 account, you probably wouldn't do this because that's a little bit too much of your cash. If you're in a $10,000 account, you certainly could do this, and you would be tying up $1,400 of cash all the way through the 3rd Friday in June. But if the stock only goes sideways, which it probably will do over the next few weeks, you're going to be taking home $210 plus whatever the shares do above 1410. Okay? All right. Very, very good stuff. I'm going to let you go. That's the end of our webinar. God bless everybody. We will have a great weekend. We will see you back in the room on Monday. I'll do one final update in the room, and then I'm heading out for the weekend. God bless. Bye now.